Greetings to everyone. I am Professor Namita Rajput, Professor in Department of Commerce, Sri Aurobindo College, University of Delhi. In the ongoing series of corporate governance, today we are going to talk on a very pertinent topic, that is insider trading. Now, insider trading refers to the buying or selling of a publicly traded company stock by someone who has non-public material information about that stock. Now, this material information could include the things like upcoming financial results, mergers and acquisitions, or significant changes in the business strategy. Insider trading is illegal in most jurisdictions because it undermines the fairness and integrity of the financial markets. Now, there are basically two types of insiders who typically engage in the insider trading. The first and the foremost what we are going to discuss is the corporate insider. Now, these are the individuals who have the access to confidential information about a company because of their position within the company. Now, this would include the executives, directors, employees who have the access to the sensitive information. The next type of insider is your tippies. Now, these individuals who receive the insider information from the corporate insider and then trade based on that information. Even if the tippee did not directly receive the information from the insider, if they know or should have known that the information was obtained illegally, they can still be held liable for the insider trading. Insider trading regulations vary by country, but in general, it is considered a very serious offence which is punishable by fines, imprisonments and the civil penalties. Now, the main reasons the insider trading is illegal include: the first is your fairness and integrity of the market. Insider trading undermines the level playing field that is essential for fair and efficient markets. When the insider trade based on the non-public information, it gives them an unfair advantage over other investors who do not have the access to that information. The next is your investor confidence. Illegal insider trading erodes the investor's confidence in the fairness of the financial markets. If the investor believes that the markets are rigged in the favor of insiders, they may be less likely to participate, leading to decreased liquidity and the efficiency in the market. The next is your market abuse. The insider trading can distort the market prices and interfere with the natural price discovery process. And when the insider trade based on the privileged information, it can lead to mispricing of the securities, which can actually harm the other investors who rely on the accurate market information. The regulators, they use the various tools to detect and prevent the insider trading, including the monitoring trade activity, conducting the investigations and prosecuting the offenders. Additionally, the companies are required to have the policies and the procedures in place to prevent the insider trading among their employees and executives. Now, let us see the legal definition and the regulations relating to insider trading. Insider trading is regulated by the security laws and the regulation in most the countries. The legal definition and the regulations surrounding the insider trading can actually vary depending on the jurisdiction, but there are common principles that are typically followed. Now, definitely we will be talking on some key legal definitions and the regulations relating to it. The first and the foremost important issue is your material non-public information, and we call it as MNPI. This refers to the information that has not been disclosed to the public and that would likely to have an impact on the price of a company's securities if it were made public. The material information is the information that is reasonable investor would consider important when making the investment decisions. Now, who is an insider? An insider is typically defined as someone who has the access to material non-public information about a company. This includes the company executives, directors, employees and others who have had the access to the sensitive information. The next is your prohibition on trading. Insider trading laws generally prohibit the investors from buying and selling the securities of their company while in possession of the material non-public information. This prohibition also extends to tippees, that is the individuals who receive the insider information from the insiders and trade on it. Now, the legal duty of trust and confidence. The insiders owe a duty of trust and confidence to their company and its shareholders not to disclose or misuse the material non-public information for the personal gain. This duty extends to both direct insiders and the tippees who receive the information inside. The next is your regulatory agencies. The regulatory agencies such as Security Exchange Commission, that is SEC in the United States, or the Financial Conduct Authority in the UK, that is United Kingdom, enforce the insider trading laws and regulations. Now, these agencies investigate the suspected cases of insider trading and can actually impose the fines, sanctions and the criminal charges on the violators. Next is your disclosure requirement. The companies are often required to disclose certain information to the public in a timely manner to ensure that all the investors have an access to material information at the same time. Now, this would help to promote the transparency and the fairness in the markets. Next is your penalties. The penalties for the insider trading violations can actually vary depending on the severity of the offense and the jurisdiction. They may include the fines, disgorgement of the profits, civil penalties, injunctions and the criminal prosecution. The individuals found guilty of the insider trading may also be banned from serving as officers or the directors of the public companies. The compliance programs. The companies are encouraged to establish the compliance program and the internal control to prevent the insider trading among their employees and the executives. These programs often include the trading, pre-clearance procedures for the trading in the company's security and the restrictions on the dissemination of material non-public information. So, overall, the insider trading regulations are designed to promote the fairness, transparency and integrity in the financial markets by preventing the misuse of confidential information for the personal gain. The compliances with these regulations is essential for maintaining investor confidence and the proper functioning of the capital market. Now, let us see the different types of insider trading. The insider trading can actually take the various forms ranging from blatant illegal activity to more subtle violations of the security laws. So, we will be discussing certain common types of insider trading. The first and the foremost is your classic insider trading. Now, what is this? This is the most straightforward type of insider trading and it violates the corporate insiders such as executives, directors or employees buying or selling of securities of their own company based on the material non-public information. For example, an executive sells the shares of their company's stock before the public announcement of the poor financial results. Next is your tippee trading. Yes, we are talking about triple T, tipper-tippy trading. This type of insider trading occurs when an insider, that is a tipper, shares the material non-public information with someone else, that is the tippee, who then trades based on that information. So, both the tipper and the tippee can be held responsible, liable for the insider trading. The tipper-tippee trading often involves the personal relationships like the family members, friends or the business associates. The next is your front running. The front running occurs when a broker or the investor advisor executes the trades on the behalf of the clients based on the material non-public information that they have about impending transactions. For example, a broker might buy securities for their personal account before executing a large purchase order for their client, knowing that the client's order will likely cause the prices to rise. The next is your misappropriation. This type of insider trading involves the individuals who are not directly affiliated with the company, but who often obtain the material non-public information through their relationship with the company and its insiders. For example, a lawyer working on a merger deal might use this confidential information to trade securities of one of the companies involved in the merger. The next is your corporate espionage. In some cases, individuals or the entities engaged in the corporate espionage to obtain the confidential information about a company for the purpose of trading on it. So, this can involve hacking into the computer systems, bribing the employees or other illegal activities to gain the access to material non-public information. Next is your trading on rumors. While not always illegal, trading on rumors can actually sometimes involve the use of the material non-public information. For example, if a trader hears a rumor about an upcoming merger and buys or sells the securities based on that rumor before it becomes public, it could constitute the insider trading. And if the rumor turns out to be a true and material, the next is your pre-arranged trading plans. While not inherently illegal, pre-arranged trading plan allows the insiders to set up a plan for buying or selling the company's stock at a predetermined times or the prices. Now, these plans must be established where the insider does not have the material non-public information and that they must be executed according to the plan terms. Now, however, there have been the cases where the insider abused these plans by modifying them based on the material non-public information, leading to the allegations of the insider trading. Now, these are just a few examples of the types of insider trading that occurs in the financial markets. Insider trading regulations aim to prevent all forms of trading based on material non-public information as they undermine the fairness and integrity of the markets. The insider trading can have a significant impact on the financial markets. Yes, we are now discussing of what is the impact of insider trading on the financial markets. Definitely, it has a huge, significant, substantial impact affecting the market integrity, investor confidence, and the overall efficiency of the markets. So, we will be discussing now certain important key ways in which the insider trading can influence the financial markets. The first and the foremost we are talking about is the market integrity. Insider trading undermines the level playing field that is very crucial for fair and transparent markets. When the insider trade based on material, non-public information, they gain an unfair advantage over other market participants who do not have the access to such information. Now, this erodes the trust in the integrity of the markets and can deter the investors from participating. The next is your market efficiency. The insider trading has a deep impact on the efficiency of the market, and it can actually distort the market prices and interfere with the efficient allocation of resources. Now, when the insiders buy or sell the security based on the privileged information, it can lead to mispricing of the assets, as market prices may not accurately reflect all the available information. This can actually result in inefficient allocation of capital and the resources, ultimately harming the overall health of the economy. The next is your investor confidence. Now, the insider trading impacts the financial market, especially when you talk about the investor confidence. The illegal insider trading can erode the investor confidence in the fair and integrity of the financial markets. When the investor perceives that the markets are rigged in the favor of the insiders, they may be less inclined to invest or trade, leading to a reduced liquidity and decreased market efficiency. There is also a loss of trust. The insider trading can lead to a loss of trust between the companies, investors, and the regulatory authorities. When the corporate insiders abuse their positions of trust by engaging in the illegal trading activities, it can actually damage the reputation of the company and its management team. This can have a long-term consequence for the company's relationship with the shareholder, customer, and the other stakeholders. Another impact of insider trading on the financial market is about a regulatory response. Insider trading often prompts the regulatory authorities to take an action to enforce the security laws and strengthen the market oversight. So, increased regulatory scrutiny and enforced measures can actually impose a cost on the market participants, which can lead to a strict compliance requirements for the companies and the individuals. There is also a deep impact of insider trading on the financial markets as far as the legal and the reputational risk is concerned. Individuals in the corporate and the companies involved in the insider trading, they face a severe legal and reputational risk. Now, let's see what it is. Investor trading is illegal, definitely, in most of the jurisdictions and across the globe, and can result in civil and criminal penalties, including the fine, including the imprisonment and disgorgement of the profits. Additionally, individuals and the companies who are found guilty of the insider trading may suffer the reputational damage, which can actually impact their business relationships and also the future prospects. So, we can say that insider trading can actually disrupt the functioning of the financial markets and undermine the investor confidence. The efforts to detect and prevent the insider trading are deeply essential for maintaining a fairness, transparency, and the integrity of the markets, and for also promoting the trust and confidence amongst the investors. Detecting and preventing the insider trading requires a combination of regulatory oversight, quick, deep internal control, within the companies and the surveillance measures by the market participants. So, there is an important common strategies and the methods used for detecting and preventing the insider trading. We need to dwell deep into it, which also includes the regulatory aspects, the other important internal control efforts, etc. So, a lot of investigations have to be done, a lot of activities have to be taken care of, and of course, when you talk about detecting and preventing the insider trading, we would be needing a very structured surveillance measures by the market participants to control and to actually arrest this illegal activity called insider trading. A deep efforts are required not only to maintain the fairness, to maintain the transparency, to maintain the integrity in the market. As if it is not under control, it is definitely going to impact the market reputational risk of the company, promoting trust and confidence amongst the investors, and it also can disrupt the market functioning, the financial market functioning, and undermine the investment process in the market. So, after having a complete process in place, we are going to reduce the chances and the probability of the reputational damage which can be caused by insider trading, to arrest this, and it is going to affect the future prospects of the company also. So, definitely not only the penalties, the fine and the criminal proceedings are required, and of course, all these going to impact the overall functioning of the company in the future, affect the business relationship and the future prospects. So, we can say we need to detect, prevent and make the system foolproof, so that the illegal activities like the insider trading can actually be clutched. This is, if it is clutched, this is going to allow the important process to come in, like the fairness in the market, the transparency amongst all the shareholders and the integrity of the markets. If the fairness, transparency and integrity are embedded into the system, time is not far that we are going to promote an important system of trust, confidence amongst the investor, and we are going to have the efficient functioning of the market. So, for this a combination is required, which is a combination of the internal systems, external systems, regulatory systems, surveillance system in place by a combination of all the market participants to actually make a difference. So, we are going to talk about the regulatory insights, the internal control insights to make the system foolproof. Thank you very much.